Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stanovic. Welcome to Bloomberg Crypto with a look at the people, transactions, and technology shaping the world of decentralized finance.
Here is what's at stake today. Bitcoin stays in a tight trading range as the Clarity Act remains stalled in the Senate and institutional adoption looks healthy.
We're going to discuss both of those angles with former CFTC Commissioner Summer Mersinger and the CEO of Wintermute, Evgeny Gaevoy.
And a hack targeting so-called cold Bitcoin wallets, raising new questions about just how secure crypto's safest storage option really is.
That's all ahead over the next hour right here on Bloomberg Crypto, but we got to just get a lay of the land, see where things stand on this Tuesday. Bitcoin spent the past week in a relatively tight trading range. Investors are balancing that resilient institutional demand, we're going to talk about it in just a second, against those geopolitical tensions and higher treasury yields. Over the last 7 days, we did see a range of as high as over $65,000 per Bitcoin, as low as just around $62,300 per Bitcoin. But overall, over the last 7 days, just up 0.4%. Also on their radar, regulatory developments when it comes to the Clarity Act. It's stalled in the Senate, Scarlett.
It's stalled in the Senate. It's been that way for a bit now. Meanwhile, Bitcoin's 14% slide in the second quarter left its mark on the Trump family-backed crypto miner. The company, American Bitcoin, posted a third straight quarterly loss of $57 million or 80 cents a share. American Bitcoin has been one of the few public companies to stay solely focused on mining the token, even as much of the industry has pivoted to AI power infrastructure. Now, institutional players are becoming a bigger part of the blockchain story. On Bloomberg Crypto last week, we spoke with Coinbase Vice Chair and Head of Corporate Affairs, Ryan Van Grack. He gave us his big picture take on the future of the industry.
We see the entire financial industry as both partners and potentially competitors, because at the end of the day, the future of finance is going to run on crypto rails, and Coinbase has been a leader in that regard. So we see an inevitable convergence between traditional finance and crypto, so that a couple of years from now, even your questions are not going to be identifying this dichotomy within the industry, but rather talking about how every modern financial institution is embracing the efficiencies and benefits that crypto provides.
All right, so increasingly TradFi and DeFi meeting in the middle. There's also evidence to support greater institutional participation in crypto markets. The market-making firm Wintermute just released its annual report on OTC flows, and it shows trades from institutions surging, rising to 72% of OTC trades through Wintermute in the first half of the year. Wintermute founder and CEO Evgeny Gaevoy joins us now from London. Evgeny, always good to check in with you. Explain why you're seeing this increase in demand at a time when we're seeing, well, I think it's fair to say, a crypto winter.
I think it's ultimately multiple angles to that. On one hand, we see a lot of interest from institutional players to basically generate yield, which on one hand drives the volumes up, but on the other hand, well, you did mention this tight trading range. It definitely compresses the vol as well. So what also our OTC report shows is that the volatility, basically realized volatility in Bitcoin dropped like almost half for the last 6 months. And it's partially has to do with a lot of those institutional players using yield-generating strategies, using options, both on upside and downside.
You know, we talk about institutional investors now accounting for 72% of OTC flows in the first half. I'm wondering how that evolved over the past year. October 2025 was certainly a turning point in turning retail in participation off. So talk about what the institutional participation looked like from that point on.
I think basically our data shows that institutional participation kept growing for the past basically 12, 18, 24 months. But especially after October last year, after this basically big wipeout of retail participation, it just was it basically accelerated even more.
I want to talk about what exactly you're seeing, like if we dig into the actual data a little bit and understand sort of the narrow set of tokens and what exactly is flowing through your platform. You know, we talk about crypto's not a monolith here, but it brings together a lot of different altcoins. And I think a lot of the interest in some of those altcoins has been lost, and there's really just a handful that account for the majority of activity. Break it down for us, Evgeny.
Yeah, basically what we see for the last 2 years pretty much is that if you look at the investable universe for for institutions specifically, we see that it basically increased by something like 24% over 2 years. So it's a very modest increase if you think about like number of tokens that was released into the market over the last 2 years. It's very modest. So it basically shows you that institutions are very focused on their approach. They're very selective into what they want to trade, and they're not really keen on expanding their tradable universe as much as retail does, for example.
You know, I want to just zero in on Bitcoin's price action for a moment, because your report notes that Bitcoin gained 11% over last month, but could not reclaim that $70,000 level, while Ethereum was up 22%. Retail, we know, has kind of shifted its attention away from crypto and is pretty much obsessed with equities at this point. You've written that the asset class is maturing, whatever recent price action suggests. So what are institutional clients actually buying on your desk right now, and why are they buying those particular tokens?
It's ultimately what you see in top 10, top 20 is also basically Ethereum, Bitcoin, Solana to a degree, are definitely dominating the volumes on our side. We do see interest in like more equity-like, for lack of a better word, tokens like Hyperliquid, more for our, like those names are very interesting. And basically it speaks to, again, on one hand, institutions being a lot more selective. On the other hand, we see a lot of decoupling of price action in those tokens as well from Bitcoin or from the rest of the market as well, because once institutions drive those, like basically most of the price action is driven by institutions at this stage and those tokens, which is very interesting.
In your view, does that remain resilient going forward? Like, is there still a lot of opportunity for institutional adoption? Where are we if we're thinking about this as like, I don't know, maybe a 9-inning baseball game?
I would say one big catalyst that we are currently lacking is the Clarity Act for sure. And in our opinion, it's basically priced in to fail this year, and it's potentially priced in to fail even with this administration as well. And so if it passes, it should be potentially like the biggest catalyst possible for not just for Bitcoin, but for alt as well.
What if it doesn't pass?
Well, like I said, I think it's already priced in. So I don't think we will see a lot worse conditions that are currently there.
All right, Wintermute CEO Evgeny Gaevoy, he says it's priced to fail at this point. We'll see what others think as well. Thank you so much. Coming up, the Senate still unclear about the Clarity Act. Summer Mersinger, Blockchain Association CEO and former CFTC commissioner, joins us to discuss the path that she sees ahead for the bill.
And to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
The crypto industry's profile in politics has risen, especially during President Trump's second term in office. But that doesn't guarantee immediate passage of the Clarity Act, which is intended to establish regulatory jurisdiction for Bitcoin and other cryptocurrencies. Romain Bostic spoke with Dan Dolev of Mizuho about his timeline for the legislation.
Clarity Act is not happening. Bitcoin, which is highly
You don't
correlated,
think Clarity Act will happen? You think that's off the table?
We don't think this year it's off the table.
Really?
I mean, we're already in August right now, and at some point it's going to happen, but it's not going to happen, this year.
Senators Tom Tillis and Ruben Gallego are leading a bipartisan group to work on a solution giving states a role in enforcing the Clarity Act's ethics provisions. Joining us for more in Washington is Summer Mersinger, Blockchain Association CEO, and of course, former CFTC commissioner. Summer, great to speak with you. There are a couple of things that are kind of delaying the Clarity Act, but from where you sit, is ethics the single biggest obstacle to the Senate passing the Clarity Act?
I think we're getting there in ethics. We seem to be on the kind of the 10-yard line here. The right players are working on it. They've had good discussions, good negotiations, and I think that we are headed in a direction where we're going to get a good vote on this bill.
But as you've mentioned, you've said ethics are the elephant in the room blocking the Clarity Act. You've also said, though, the industry isn't trying to dictate ethics provisions and what they should look like. The president, we should note, disclosed a $1.4 billion in personal crypto income. His family runs World Liberty Financial, plus a meme coin. Democrats will not vote without these new guardrails. Can the industry really afford to stay neutral on ethics when ethics could be the thing that kills it?
I think that it's up to the government officials. You know, this is an ethics agreement that will impact all of the elected officials, and so that's something that they need to work out together. Again, the right people are having the right conversations, and so we're headed in a good direction. And from crypto side, you know, we've just really encouraged them to keep talking so that we can get this across the finish line.
But what, from an ethics perspective, what gets it across the finish line? Like, who has to give here?
I think where the two senators, Tillis and Gallego, where it sounds like they are headed, probably is the right direction. You know, at the end of the day, we are still waiting for Democrats to say that they support this bill, and I'm hopeful that this is what gets them to yes.
I wonder also about the context. Cryptocurrencies have been mired in a slump. People call it a crypto winter. If Bitcoin were trading above 100,000 rather than holding at around 60,000, do you think there would be more urgency for both Democrats and Republicans to reach some kind of compromise? Because right now, both sides probably feel that they have time on their side to press their cases.
I think what both sides recognize is the status quo is not working, that they have to get something done. And the longer it takes to get something done, the longer we are without certain customer protections, without law enforcement tools. And so I think there's just this recognition that, you know, we need to get something done sooner rather than later. The status quo is not going to work in the long term. And, you know, if the opportunity is now, let's take advantage of it.
You say that something needs to get done. For consumers, those who either invest in or trade crypto or are trying to move on chain, what's in it for them? How is Clarity Act going to change how they proceed, how they move forward?
Yeah, absolutely. There's a number of disclosures. A disclosure regime that does not exist right now will be in place. You will also have regulators overseeing these markets, and that means you're going to have people in there examining them, making sure they know where the money is. Right now, you don't have requirements for customer fund segregation, so there's no protection from bankruptcy. This is something that the bill will do, is ensure that customer funds are kept safely and remote from any bankruptcy proceedings. So there's a lot in this bill that makes it a strong customer protection law.
In a previous lifetime, you were a longtime senior advisor to Senate Majority Leader John Thune. Can your relationship with him, with his office, get this across the finish line?
You know, we're both from small towns in South Dakota, and I think what he would say and what I would say is independent thinking is in our blood. So I have no illusions that, you know, my voice is going to be what makes him come to a conclusion. He's working closely with his caucus, with the minority leader, and all of the other kind of issues that are out there are playing together as far as timing. But yeah, he's an independent thinker, and that's part of the reason I enjoyed working for him, is that he does things the right way in his own, you know, with his own reasoning.
Have you spoken to him about this?
You know, I have spoken to some of his staff. We keep in close contact with them. Mostly it's kind of coordinating. The Blockchain Association has done a ton of grassroots work in the last month. We've had hundreds of meetings in the Senate. We created a new website called clarityforamerica.com, and that's where you can go and send unique constituent letters to senators. So making sure they know the efforts that we are putting in, where we see maybe offices that have questions that need to be clarified. It really is, we're working hand in hand to get this done.
And before we let you go, Summer, I just want to get a sense again of, based on your years of experience in Washington, understanding the legislative calendar, explain to us why this is kind of the last window of opportunity for the Senate to move forward with Clarity Act. Because if it doesn't get it done before the recess, then what does the calendar look like in the fall and post-midterm elections?
Yeah, I mean, I think this is an ideal time. You know, a lot of times, in my experience, the Senate does perform best when there are timelines in place, when there's a deadline of some sort, and I think we're facing that right now with the upcoming August recess. And, you know, things just get harder around midterm elections. Things are really hard to do in lame duck sessions. So I'm not saying it's impossible, but, you know, right now the timing is right. We're so close. And, you know, given my years of experience in the Senate and on Capitol Hill, I think we're going to get there.
When?
By the end of the week, I think we'll at least have some kind of cloture vote, at least, to see where, you know, to see where everyone is, to see if we can, you know, move ahead with the bill. There might be a break in between when you get cloture on the motion to proceed and when you actually have final passage, but that's okay because crypto's not going to go away. We're going to keep pushing on this. We're going to stay on the Hill. We're going to keep having these conversations, sending these letters, and making sure that no one forgets that this is critically important to their crypto voters in the United States.
Summer Mersinger, Blockchain Association CEO, also former CFTC commissioner, joining us from Washington. Well, coming up, the big story of the weekend, an ongoing hack of cold Bitcoin wallets has the crypto industry on edge, with more than $100 million worth of Bitcoin already stolen. That's next. This is Bloomberg. Hackers have found a way to steal more than $100 million worth of Bitcoin from thousands of accounts on CoinKite's cold wallet, which means it isn't connected to the internet. Bloomberg's Lauren Tara LaCapra reported on this, and she joins us here in New York. How did this happen? I mean, I was reading about one of the victims here, and he said his part of the system was in like a safety deposit box at a bank.
Yeah, I mean, people had the perception that if you have a cold wallet, that it's secure. And I think this has kind of upended that impression. You know, there was a security flaw in CoinKite's system that someone, it seems, might have even hacked into it all the way back in April times. But then the news kind of blew up over the weekend because a lot of other users were complaining about their accounts getting drained, and so they have a whole mess on their hands now.
And do most people have all their Bitcoin in one storage place, or do they kind of diversify and spread it out, kind of the way that people spread out their deposits at banks?
Yeah, I think it just depends on the person. There were some very sympathetic, harrowing stories of one guy was saying he bought 2 Bitcoin for his children's future. Another guy lost all of his savings because he just had it there. But I'm sure some of the users have it in different places too. Can
we draw any sort of corollary, like if this were to happen to somebody at a bank and, like, you know, their account were somehow compromised at one of the you know, regulated financial institution, would there be better recourse than if it's lost in Bitcoin? Certainly, yeah. I mean, that's going to be a big question that we still don't have an answer to, is what are the repercussions for CoinKite, if any? Is there going to be litigation? Is there going to be any enforcement action? But in terms of the money, I mean, it's kind of like kaput. You don't have the same FDIC insurance and things like that. Yeah, I'm guessing CoinKite doesn't pay anyone to insure the deposits there. Yeah. What do we know about CoinKite, the company? Not a whole lot. It's a small company. It's based in Toronto, I believe. There was some commentary online by upset users about the CEO saying that he was not, you know, aware enough about the flaws. I'm sure that we'll find out more about them in the coming days. I mean, our team certainly is trying to get in touch with people there, but I think they're like heads down trying to get their arms around the problem. So I think for a lot of people, this was a system where, you know, something's in cold storage is seen as a lot safer than a system where something completely lives online, like maybe, you know, in an exchange, for example. Does this just shatter that notion? I mean, I would say so, yeah, because it's exactly like what you're saying. People had this perception that it's safe because it's on like a physical brick. I mean, look, you're not going to give financial advice or advice about people, you know, how people should store their crypto, but based on the folks you've spoken to and your team out reporting on this, what is the right way to store a digital asset? You know, you've seen some of the exchange executives come out and say that their way is better.
And then you've seen some people come out and say, this doesn't ruin cold wallets. It's one bad example. It doesn't ruin the whole bunch. But I think time will tell if there are more hacks like this. Because they're not the only one that provides that device,
Right, and there have been a series of hacks too, perhaps not as many given that Bitcoin's price action has not been as robust as it was in previous years. But Eric Balchunas of Bloomberg Intelligence has been writing that the cold storage Bitcoin heist definitely shakes the faithful and strengthens the ETF case, where you get exposure to Bitcoin through ETFs rather through actual I don't want to say physical Bitcoin, but through owning Bitcoin and putting it in cold storage wallets.
Yeah, certainly. I mean, you could see the argument for that, right? If you had the ETF and not the actual underlying asset, you might not be in such a bad situation. So it's a good time for Eric to be writing about it.
Do we know that, we can, not we, but this type of asset can be traced? And I'm wondering if the authorities...
Isn't that the point of the blockchain?
Yeah,
right?
It is. I mean, and I'm wondering if authorities have any sort of, not leads about who has it, but at least where it went.
Yeah, I mean, this is already, there are a lot of technical analysts going out there trying to scour, the CoinKite application and the flaws and it's like a big whodunit in crypto world, right? No one knows who the original hacker was, but now there's more than a dozen that have been identified. And, they're just identities. You don't know their name or anything. So I think there will be more to cover in the coming days.
Okay, still a lot to unravel then. Lauren Tara LaCapra, thank you so much. She is a reporter for Bloomberg News covering cross assets, including cryptocurrency. Tim?
Well, coming up next, tokenization of traditional assets. It's gaining momentum. But Ophelia Snyder, the co-founder of 21 Shares, warns that the hype surrounding tokenization are outpacing the reality. This is Bloomberg Crypto.
Welcome back to Bloomberg Crypto. I'm Scarlett Fu alongside Tim Stenovic.
Well, something unusual is happening at the intersection of crypto and AI infrastructure. The CME Group building futures markets around GPU pricing that is the cost of high-performance computing.
Also, Bitcoin miners are signing billion-dollar deals to host AI compute. Two worlds that seemed unrelated are converging very quickly. And that brings us to Money Rewired. And we're pleased, as always, to welcome back Dee Sharawat. He is our senior analyst at Bloomberg Intelligence, covering fintech and crypto. And he joins us from Boston with more. Dee, great to see you, as always. Let's start on the first topic. The CME, the world's biggest futures exchange, teaming up with Silicon Data to launch the first ever compute futures market this year. What exactly is this? Just break it down for us. And why does it matter? Why is it so significant?
Yeah, sure, Scarlett. So fascinating news coming out. It's the first attempt by a major derivatives player to bring derivatives to compute. So let me lay it out what the problem right now is. That if you happen to be one of the AI builders, right, you are XAI, you are OpenAI, you are Anthropic, the problem that they have is, they are highly sensitive to what compute prices might be in the future. On the sell side, let's say you are Oracle, you are Azure, you're Amazon AWS, you want to hedge against the prices of computing power collapsing. So both sides of the market today do not have a hedging instrument. This is CME's attempt to bring derivatives to compute. So same pattern. The pattern is, think about what CME did to Bitcoin back in 2017, took an asset class, brought derivatives to the market to make it investable, tradable, hedgeable. We're doing that. This is now taking place in compute futures. Terry Duffy, CME's CEO, said that this is basically the next computing power is the next oil for the next 10 or 15 years. So this is bringing derivatives to AI compute for the future. And
if we think back to this spring at Milken, Larry Fink talked about this and this being the huge opportunity. So it's not just CME, though. I mean, just a few weeks ago, we saw Kalshi creating a tool that plots the future price of computing power. It's the prediction market. It will offer an exchange, or rather a forward curve that tracks compute, which is shorthand for the power storage memory, and other resources used in AI processes. That's according to the executives. Udish Jha is now Kalshi's chief risk officer. He was at CME Group for years before this. Is this the same thing? Is Kalshi doing the same thing that CME Group is doing?
As of now, I mean, the details are a little scant, Tim, because this is just breaking over the last 4 to 6 weeks. There are 4 major players actually in this space. CME clearly is the largest and the biggest player, but close to them, ICE is going to be offering something in compute features as well. Third player is going to be Kalshi, and the fourth player is a smaller company called Architect, run by a gentleman called Brett Harrison. So all 4 major players, all 4 players are actually gunning to provide compute features. So it's related, but it's going to be different scale as well compared to what CME is doing.
Okay. I'm wondering if with Brett, you mentioned Brett Harrison, so former FTX guy, right?
That's correct.
Okay, so yeah, we used to speak to him all the time when he was president of FTX US. That was like, at this point, ages ago in the world of crypto.
That's right.
The 4 different players who you mentioned, do they serve different groups, or are they all going for the same customer?
Right now, they're going for the same customer, Tim. Like I said, it's very straightforward. At 2 sides of the market, there is a buy side, there's a sell side, right? On the buy side are the folks that need to buy computing power. On the sell side are the cloud providers that need to offer it. Third leg of the stool obviously has investors, both retail and institutional investors. The part we haven't talked about, there's also going to be ETFs on compute futures in the next 12 to 18 months, which brings the retail angle. So you're bringing all the parties that are involved in setting up a new market. Buy side, sell side, liquidity providers, no different than equities, no different than fixed income, foreign exchange, Bitcoin. This is bringing all of that market structure to computing power. So to answer your question, I mean, details aren't very, are a little bit sketchy right now, or not detailed enough, but they're all 4 going after the same market. I also want to very quickly point out, it's very interesting you mentioned CME and Kalshi. We obviously know that CME has been fighting hard against Kalshi's attempts at trying to do stuff in the perpetual future space, right? Arguing that perpetual futures actually swaps. But in this case, they're obviously both moving in the same direction. So CME is playing offense on the one side when it comes to compute futures, and defense on the other side when it comes to perpetual futures.
Yeah, that is interesting, and it shows how nimble these exchanges, these traditional exchanges, now find themselves needing to be. Big picture here, Dee. Why now? What does this convergence of AI and financial markets signal to you?
Yeah, sure. So I think what's interesting here, Scarlett, is that the crossover between crypto is that the biggest players in the AI computing power that could benefit from these derivatives instruments is actually going to be the core Bitcoin mining guys, Core Scientific, IREN or IREN, other places like Marathon, Riot, Digital. I've got a whole list here. I don't really cover this space as much, but they're beginning to be major players in the space. Hut 8 as well. These are all players that, over the last 5 to 8 years, built a very good business in Bitcoin mining. Now they're actually taking that infrastructure and actually leveraging it and moving it towards AI computing power. So they are now less exposed to the vagaries of the Bitcoin market, more exposed to what's happening in the AI compute market. So this is a crossover between the traditional crypto and Bitcoin mining players and the AI space. Again, why now? Because you can see the computing power is becoming the biggest demand factor, and yet we don't have a well-functioning derivative market to hedge against, speculate, invest in, around computing power. So this is, again, like I said, the long pattern about new asset class. First, you've got spot pricing for it, then you've got a derivatives market for it. All of those assets that are built on top of the core product are beginning to come on into the compute futures market.
So you mentioned some of these like convergence of crypto and AI firms. I'm wondering, if somebody owns like a mining stock, you mentioned Hut 8 earlier, is this still a Bitcoin or crypto play, or is it increasingly like high performance computing? We've seen, on our program, we've spoken to executives at companies that have literally pivoted from crypto to high performance computing. Like, how do you look at that as an analyst?
Yeah, so as both of you know, and the listeners might know, I'm a market structure analyst. I'm not an equity analyst, so I'm not going to opine on the valuation of these stocks. But I think you're absolutely right, Tim, that a lot of most of the mining guys are basically, pivoting towards providing, like I said, infrastructure. Like, the Bitcoin mining guys have a very vital asset, which is tracts of land, cheap power that they've been utilizing till now for Bitcoin crypto mining. They're now using that for compute mining, computing power, which is much better for them because they're, like I said, they're not subject to the vagaries of the crypto market. The computing power is a much larger market, more stable market. There's a tremendous demand for that. So, and you can see that reflected in the valuation, relative valuation of the Bitcoin mining stocks. People that are, folks like Marathon that were very strong 5 years ago, that are a little bit behind compared to the Hut 8s and the Irenes of the world that have pivoted much more towards computing power. The valuation for folks like Marathon tend to be much lower. So the institutional investor market is recognizing that those Bitcoin mining companies that have transferred over or moved into AI computing power are valued much more than the traditional guys that are still stuck to the mining side.
All right, Dee, we're going to end it there, but thank you so much. It's a great setup for us. Dee Charawat at Bloomberg Intelligence joining us from Boston. He's a regular here for Bloomberg Crypto. Now, sticking with the financialization of AI, let's continue this discussion with Ophelia Snyder. She is co-founder of 21 Shares. Ophelia, you heard what Dee was saying about this convergence between what were formerly crypto mining companies just transitioning into AI infrastructure companies. What do you think of this wholesale move? It seems like a wholesale move, at least. And how does it change the economics of a company that's doing just that?
It makes sense. I think there was a moment where a lot of these companies were quite prescient in securing power contracts and securing infrastructure contracts and actually building the necessary infrastructure. I think the shift has made the competition for compute continue to grow, and I don't expect that to abate anytime soon. And there's no reason these firms that are specialized in doing it can't provide those services.
What if we see, and I say what if, but there are a lot of folks we talk to who say we will see Bitcoin go past $130,000 again at some point. When that happens, or if that happens, do these firms come out and say, wait a second, we're not actually focused on AI compute now. We're going back to mining Bitcoin because there's money in them chips?
I suspect you will see both, and it likely makes these firms more robust, not less. They're economically rational decisions.
So being nimble is a feature at this point.
I think so. I think generally,
can they,
that's a good
from
thing.
a technical perspective, can they switch on and off easily, to like from one specialization to another?
My understanding, and this is obviously, I'm not a Bitcoin miner by trade, but my understanding is it's not 100% fungible.
Okay.
It's more a function of power costs and infrastructure and what the best use of that is, which is not dissimilar from what you typically see around Bitcoin mining. There are moments when it's more or less profitable, and certain locations are more or less profitable, so I expect the decision matrix to remain pretty consistent.
All right, let's shift gears to tokenization, because Ophelia, you've said that crypto and TradFi are kind of talking past each other when it comes to tokenization. And we certainly see no shortage of announcements of traditional finance companies getting into tokenization. Wells Fargo today, for instance, saying it'll roll out tokenized deposits for commercial clients. In a situation like this, where you get an announcement from a Wells Fargo, for instance, what needs to happen behind the scenes to make sure that it isn't just an announcement that kind of lands and doesn't go beyond that? I mean, what needs to happen for everything to actually come into practice?
So I think one of the things that's being undervalued in crypto markets today is how early some of these implementations really are. These are, even though the numbers appear big to crypto, they are not big compared to what flows in TradFi really look like. And so I think you're going to continue to see a lot of interest in these projects, a lot of desire for them to expand. I think these implementations are critical proof points, but they don't represent a wholesale migration of infrastructure yet. They're much more like test balloons than they are, full-scale implementation.
What would you need to see in order to say, okay, this is no longer a test balloon, we're now seeing full-scale implementation?
You would need to see a significant percentage of flow. And I think that's the piece, or a significant percentage of assets, right? Right now you're seeing, either a few hundred million, maybe a couple of billion, that pales in comparison.
Which sounds like a lot to, somebody, but you said pales in comparison. Okay.
Compared to the actual size of these balance sheets, the actual size of the total market for bank deposits compared to the total size of equities markets. I mean, those are the benchmarks. And when you think about new capital markets technology, which essentially this is, varying flavors of it, but new capital markets technology and new payments technology and new settlements technology, you actually need that critical mass. And that's the part that's interesting. So you're seeing all these test cases, and a lot of that seems to be going quite well. And you speak to these institutions, and they're excited about it. Mm-hmm. The question then becomes, okay, well, what is the gap between these really exciting initial trials and saying, okay, actually, yes, we're going to do it for our entire deposit base? And that gap is, I think, what we're going to be bridging in the next few years.
Right, to actually matter at an institutional scale. Is this a 5-year problem? Is this a 20-year problem? What's the timeline?
So I suspect it's a 5-year problem, maybe 5 to 10. I think you need to get a critical mass going, and then it kind of rolls, and the roll part will take a long time, similar to what you saw with like the migration from mutual funds to ETFs. These are not small shifts when you start moving large amounts of money. You're still seeing people deprecate proprietary systems in favor of cloud, and that's still happening right now. Like, cloud transformation is not 100% complete. I don't think 100% is the goal. I think it's that critical mass. Like, once you get to more than half, the market starts to shift around that. And so I think that inflection point is maybe 5 years out.
So you think TradFi and DeFi are overhyping tokenization here?
No, not in terms of what it can do, but in terms of what it's going to take to go from these initial proof points to full-scale deployment. Requires a lot of middleware. There's a lot of connectivity that goes into that, whether it's updates to risk models to now take into account the possibility of being margin called on a Saturday, or your accounting principles and how your core books and records actually capture these transactions. None of that infrastructure is entirely controlled by any of these financial institutions. They buy some, they build some. It's brought together in a variety of different ways.
It's kind of a hodgepodge.
It is, and that takes a very long time to migrate and update. So you do the test balloons, you see that it works, and then you start thinking about, okay, how do you think about updating core systems? And these are critical dependencies for doing any kind of business for these firms. And so what does it take to put a new technology in a critical dependency pathway? And I think that's the question that we're answering now. What's required to do that? And that's really exciting. I think it's just going to take a bit more work than maybe people currently realize.
Yeah, certainly it's not encapsulated in those exciting, breathless announcements about what they're doing, right?
Exactly.
Stay tuned.
Yeah, absolutely. It's great to speak with you. Thank you so much for joining us
Thank
today.
you for having me.
That's Ophelia Snyder, 21 Shares co-founder, joining us here in New York. Well, coming up, we're going to talk to the head of crypto at Visa about the new stablecoin platform. That's next on Bloomberg. Banks and fintechs are preparing for wider adoption of stablecoins. Yesterday on the close, the CEO of stablecoin payments provider Yellow Card had a bold prediction for the technology.
I think when you look at international transactions, within 10 years, people will not be using other forms of moving money across borders, right? And even if you are using, a company or anything like that to move that money across borders, they're going to be using stable coins on the back end. It's just such a paradigm shift in the way that money moves across borders.
Meanwhile, Visa has unveiled its own stablecoin platform. It's designed to let financial firms issue, move, and manage stablecoins. Here to discuss is the head of crypto at Visa, Kai Sheffield. Kai, good to have you on the program. Can you just talk a little bit about the demand that you were seeing before you created this product? Like, who's it for and why?
Yeah, sure. So we talk to banks and financial institutions, all over the world. And I think at this stage, every bank needs to have a stablecoin strategy. And so they were coming to us and really finding a challenge of where to start, what infrastructure do I need? And so we built the Visa stablecoin platform to be the single place that banks can go to get the infrastructure to build on chain, and then to combine that with professional services where we have a Visa consulting team that goes out and helps banks understand the market, figure out which use cases they should focus on, and then be able to execute those use cases on our infrastructure.
So you launched the Visa stablecoin platform 3 weeks ago. What have you seen so far? What's been the feedback that you've gotten so far?
Yeah, I think the challenge that a lot of banks have is it's really hard to cobble together vendors across the different components of the stack, and particularly going through risk committees, partnering with a crypto startup. It's much easier to buy from the partners that they know and trust, that they work with already. And so we're trying to go out and partner and build and invest and create the best set of capabilities that we can put into one place. And then we're the place that can deliver that to the bank the most easily for them to consume.
Kai, the Visa dashboard shows adjusted stablecoin volume hit a record $1.79 trillion in June, $8.8 trillion in the first half of this year. most of that happened without Visa. Why do stablecoins need Visa?
So I think the stablecoin business at Visa is in an amazing spot right now, mostly with the lead that we have with stablecoin linked cards. We look at stablecoins as great infrastructure, but they don't have acceptance. And so you need the ability, if stablecoins are going to become a form of money, to spend them at 200 million merchants across the world that accept Visa. So we've seen stablecoin linked cards growing at triple digits over the past year. And nearly every week, there are new stablecoin linked card programs that are going live across our network. You might have seen Western Union today. They just launched their stablecoin card. And so we think there's a whole generation of fintechs building on the infrastructure that still recognize the need and the value that Visa can provide, connecting them back to the existing financial ecosystem.
Kai, the Visa stablecoin platform launched with OpenUSD, which is from the Open Standard Consortium, not USDC, not USDT. This is a new stablecoin that I don't think a lot of people have heard of. USDC, by contrast, has $70 billion in circulation. USDT has more than $180 billion. Why would Visa launch with a stablecoin that few people have heard of, that doesn't have a lot of market share, rather than going with something that institutions already use, that has a name recognition?
Yeah, so I think it's super early for the stablecoin ecosystem overall. We joined Open Standard, and we're proud to work with about 140 partners around designing a stablecoin that we think has economic and governance properties that can help set it up to scale. But at the same time, we continue to support USDC and other stablecoins, and we work with them across settlement, which just reached about $10 billion in annualized volume across our network. And so we're going to continue to support many stablecoins, but we think that there's still room and opportunity for new stablecoins to emerge like Open Standard that can have the right governance properties to help them scale.
Kai, as we mentioned, we're just a few weeks into this. Visa's just a few weeks into this. What's the metric that you're going to use internally come the end of the year that says this has been a success, just in 30 seconds?
Yeah, I think today it's just the number of banks and institutions that are onboarding. We have a sandbox right now. The team is just overwhelmed with demand of clients coming to us. But it takes time for institutions to be able to launch these products. So we've got to be able to get them into the environment, help them figure out use cases, and then deploy those use cases into the market over the coming year.
All right. Kai, appreciate you joining us. Kai Sheffield, out there in San Francisco. He's head of crypto over at Visa. The new product just launched a few weeks ago. That's it.
That does it for Bloomberg
That's
Crypto
it. That's
this
all
week.
The time we have, but it's okay. We'll be back next week.
Yeah, and much more to cover as we continue to see TradFi adopt tokenization and on-chain and everything else.
They're now shaking hands.
Worlds are colliding.
They really are.
Let's see if Clarity Act goes anywhere.
By the end of the week, at least that's what Summer Mersinger says. We'll see you again next week. This is Bloomberg.